A stablecoin run, as highlighted by Brookings, can erupt at any hour on any day across multiple blockchains at once. This is not speculation, it is verified, irrefutable. The second historical example to understand is the savings and loan crisis of the 1980s, arguably the most thoroughly documented instance showing how bank lending suffers when deposits migrate to higher yield competitors and regulations lag. In the late 1970s and early 1980s, money market funds successfully drew deposits from banks, leaving savings and loan institutions facing a severe funding crunch. These institutions were burdened with long-term fixed-rate mortgage assets yielding 6% while competing for deposits meant offering 12 to 15% on money market rates. Their net interest margins plunged into the negative, triggering institutional failures. The FSLIC was overwhelmed, and Congress eventually allocated over $160 billion taxpayer dollars to resolve the fallout. The lesson for the genius trap lies in speed and the magnitude of response. Unlike the savings and loan crisis, which unfolded over roughly a decade from the initial competition to peak institutional failures, the digital stablecoin ecosystem operates at instant global speed. If the Treasury Department's Advisory Council estimate of $6.6 trillion in deposits migrates over 3 to 5 years instead of 10 to 15, the banking system's ability to absorb the shock will be tested far faster than historical resolution mechanisms were designed to handle. The third relevant case is Silicon Valley Bank in March 2023, offering the most direct precedent for the systemic risk that stablecoins pose, as Brookings described in its May 1, 2026 comment. SVB held roughly 90% of its deposits in uninsured accounts. When confidence faltered, $42 billion were withdrawn in a single day via digital channels, marking the fastest bank run in American history. Digital banking infrastructure enabled this speed, allowing mass simultaneous withdrawals at a rate no bank could absorb. The stablecoin system mirrors this digital speed withdrawal mechanism, albeit on a different layer. If a stablecoin issuer keeps reserves in uninsured bank deposits and confidence in either the stablecoin or the bank waivers, the two-way run dynamic Brookings outlined can trigger simultaneous withdrawals from both the stablecoin and its underlying bank reserves. The regulatory framework being finalized by the OC, FDIC, and Federal Reserve with a statutory deadline of July 18, 2026, aims to prevent this two-way dynamic from triggering a systemic crisis. Yet, the regulations remain drafts, leaving the loophole open while the stablecoin market continues its monthly growth. At this juncture, it is critical to directly address you. If this analysis clarifies the genius trap by connecting complex regulation to your own bank deposits, it is exactly the synthesis intended. The July 18, 2026 regulatory deadline is the single most crucial date in the banking calendar for the rest of 2026. Rules are still in formation before that date. After it, the final rules take effect, and the consequences become explicit. There are 3 urgent points every bank depositor must grasp. First, the difference in protections between a bank savings account and a stablecoin reward account. Bank savings accounts held at FDIC-insured institutions below the $250,000 per ownership category per institution limit are safeguarded by the full faith and credit of the United States government. This protection is tangible, has functioned reliably through every bank failure since 1933, and stands among the most dependable financial guarantees in history. In contrast, stablecoin reward accounts provide no such protection. As clarified in the FDIC's April 2026 proposed rule, stablecoins are explicitly not eligible for FDIC pass-through deposit insurance. If a stablecoin issuer collapses, depositors are unsecured creditors. If the bank holding those reserves fails, depositors are doubly exposed. The advertised 3.5 to 5% yield advantage of stablecoin reward programs carries the inherent risk of an uninsured financial product. This does not inherently mean avoidance. It emphasizes understanding exactly what is being exchanged for the higher yield. Second, every depositor needs to comprehend the regulatory deadline's implications for the stablecoin landscape. The OC, FDIC, and Federal Reserve must finalize rules implementing the Genius Act by July 18, 2026. If these rules successfully close the yield loophole prohibiting platforms, not just issuers, from offering interest or yield-equivalent rewards on stable coins, the competitive advantage that draws deposits from banks will vanish. Under this scenario, the $6.6 trillion deposit risk estimated by the Treasury's Advisory Council would not materialize at the projected scale. Conversely, if lobbying by the crypto industry, which spent $131 million during the 2024 election cycle supporting 274 pro-crypto candidates in the House, or legal challenges, or the White House's April 2026 report advocating stablecoin growth, prevents the regulations from closing the loophole, competitive pressure on bank deposits will continue building to the levels the ABA and Federal Reserve models forecast as harmful to lending capacity. Third, depositors can take immediate protective action regardless of regulatory outcomes. Ensure every dollar in savings resides in an FDIC-insured account below the $250,000 limit per ownership category per institution. For balances above this threshold, use the FDIC's Electronic Deposit Insurance Estimator tool at FDIC.gov to structure holdings across multiple accounts and institutions, maximizing insurance coverage. This precaution costs nothing, takes roughly 30 minutes, and provides protection whether the genius trap is neutralized by regulatory action or manifests through deposit migration, as warned by the Treasury Advisory Council. FDIC insurance safeguards against banking system stress, independent of its cause. With the $6.6 trillion deposit risk actively debated at the highest regulatory levels, ensuring your deposits are fully insured is the most crucial financial hygiene step available. The genius trap is currently forming at regulatory speed, driven by technology, yield competition, and legislative intricacy, precisely as the ABA's January letter warned. Regulation can mitigate the trap. Individual depositors who comprehend and adhere to the protection framework can avoid it. Anyone following this analysis can grasp the full complexity. The approaching July 18th deadline makes attentive monitoring essential. The Federal Reserve's own analysis of stablecoin deposit risk provides the most authoritative, quantitative assessment of the trap's potential scope. Its scenarios directly inform the regulatory outcomes being determined under the July 18th deadline. Published in December 2025, the study modeled the impact of stablecoin adoption on bank deposits and credit availability, outlining 3 scenarios. In the moderate adoption case, with stablecoins increasing by $500 billion from current levels, bank lending effects are modest but measurable. The elevated adoption scenario, requiring roughly $1 trillion in stablecoin growth, significantly reduces lending, affecting small business and agricultural credit in particular regions. In the high adoption scenario with competitive yields, bank lending contraction reaches $1.26 trillion, including $110 billion in small business credit and $62 billion in agricultural lending. These figures represent the downstream consequences of deposit migration enabled by the genius loophole. The communities losing agricultural credit are real farming regions in Indiana, Nebraska, and Kansas, where local bank loans provide essential operating capital for planting seasons. The $110 billion in small business credit losses affects local hardware stores, restaurants, contractors, and healthcare practices, not large corporations with diversified banking access. The genius trap is a Main Street story, not merely a financial market one. The $6.6 trillion deposit figure abstracts the reality. The $62 billion reduction in agricultural credit translates into tangible hardships for farmers relying on community bank loans to plant crops in April. The political economy of the genius loophole explains why it remains unclosed despite the ABA's January warning, the OCC's March proposed rules, the Federal Reserve's December modeling, and the Treasury's $6.6 trillion estimate. The crypto industry's $131 million investment in the 2024 election cycle, as reported by CoinGecko, supported 274 pro-crypto house candidates, forming a congressional coalition that interprets any restriction on stablecoin yield as anti-competitive protection for banks rather than deposit insurance safeguarding. The White House's April 2026 report explicitly downplayed the deposit threat, asserting that stablecoin yields would minimally affect bank deposits and primarily impact large banks, leaving small community banks relatively shielded. ABA economists publicly countered, noting that such analyses start from the wrong question, framing stablecoins as a payments innovation rather than recognizing them as economically risky alternatives to insured bank deposits. The disagreement between the White House economists, who downplayed the deposit threat, and the ABA economists, who quantified it at $6.6 trillion using the Treasury's Advisory Council data, is not a debate over analyst credibility. Rather, it stems from differing assumptions in their models regarding how rapidly consumers would react to yield differences between stablecoin reward programs and traditional bank savings accounts. The White House presumes consumer behavior is relatively sluggish. The ABA assumes people respond decisively to financial incentives. The empirical test that settles this debate is straightforward. When stablecoin reward programs offer competitive yields, do consumers shift their funds? The answer, revealed by the market growing from nearly zero to $281 billion in 5 years, is unequivocal. Consumers do respond to yield differentials. The remaining questions concern only the magnitude and speed of that response. This is where the genius trap intersects with broader financial pressures. It is not an isolated digital asset phenomenon. It converges with the stress already present in the banking system, documented across multiple analyses, Banks are facing commercial real estate maturities, FHA delinquency at 11.52%, the first bank failure of 2026 in February, and repo market strain at levels not seen in over 20 years. The Federal Reserve has published research demonstrating that under stagflationary funding shocks, bank profitability and capital ratios decline significantly for a meaningful subset of institutions. Into this already stressed system, the Genius loophole introduces competitive pressure for deposits at precisely the wrong time. Banks already managing balance sheet stress cannot simultaneously absorb outflows to stablecoin platforms offering 3 to 5% yield. Those experiencing rising funding costs due to the Federal Reserve's policy constraints cannot be forced to compete with a digital ecosystem whose regulatory burden is only a fraction of a chartered bank's. The Genius trap enters a banking environment with minimal buffers, the lowest since the post-financial crisis era. Consequently, the July 18th deadline is not merely a regulatory checkpoint for digital assets, it is the most consequential structural banking decision of 2026. Whether the rules close the loophole or permit yield competition at scale will determine if the $6.6 trillion deposit risk remains hypothetical or becomes reality in the second half of 2026 and into 2027. The stablecoin market currently stands at approximately $281 billion as of March 2026. Treasury Secretary Besant has described $2 trillion as a very reasonable estimate. Citigroup research projects a range of $500 billion to $3.7 trillion by 2030. Using the Treasury's Advisory Council data, the ABA estimates $6.6 trillion in transactional deposits are potentially at risk. The Federal Reserve's high adoption scenario predicts a reduction in bank lending of $1.26 trillion. These are not isolated projections. They represent the documented spectrum of scenarios publicly assigned by the most authoritative U.S. financial institutions to the risk posed by stablecoin deposit migration. At present, the $281 billion in the stablecoin market is roughly 4% of the $6.6 trillion at risk figure. In other words, 4% of potential deposit migration has already occurred. 96% of the risk remains in bank deposits, still protected by FDIC insurance, still funding community bank lending, and still forming the core of the American banking system. The regulatory outcome under the July 18th deadline will determine whether that remaining 96% migrates gradually, rapidly, or not at all. Individual depositors can act now to protect themselves by ensuring that all savings are in FDIC-insured accounts below the $250,000 limit. These actions safeguard deposits regardless of whether the regulatory battle is won by the banks or the crypto industry, whether the $6.6 trillion migrates or stays, and whether the loophole is closed or exploited. FDIC insurance is the protection that consistently works. Understanding precisely where that boundary lies for each account at each institution is the most crucial financial self-protection available to any American in May 2026. The international context further clarifies the stakes for domestic regulators. The United States is not alone in building stablecoin frameworks. Singapore finalized its regulatory structure in August 2023. The European Union's markets and crypto assets regulation took effect in June 2024, with the transition period ending in July 2026, coinciding with the U.S. Genius Act implementation deadline. Hong Kong's stablecoins ordinance became effective on August 1st, 2025. Brazil released its framework in November 2025. In a geopolitically significant move, China allowed its digital yuan, the ECNY, to pay interest on verified wallets in 2026, establishing a precedent for sovereign digital currencies offering yield. These international policies are directly relevant to the American debate. If the U.S. closes the stablecoin yield loophole while China's ECNY pays interest, the EU's MiCA framework allows some yield structures, and Singapore permits competitive returns, the question arises, will the U.S. dollar-pegged stablecoin ecosystem lose competitiveness to non-dollar alternatives? Treasury Secretary Besant has cited expanding global dollar dominance as a key motivation for supporting stablecoin growth. The policy tension lies between promoting dollar dominance and protecting bank deposits, a central issue the July 18th deadline must resolve. The ABA argues that compliant stablecoins can grow dollar dominance without cannibalizing bank deposits through yield. The crypto industry contends that prohibiting yield undermines dollar-pegged stablecoins' competitiveness against yield-bearing alternatives. Both positions present coherent policy rationales, and the regulatory decision will determine which prevails, shaping the global stablecoin market and the domestic bank deposit base for the coming decade. The Federal Reserve estimates $65 billion in small business credit could be withdrawn under the high adoption competitive yield scenario. That represents the total reduction in credit available to community bank-dependent small businesses nationwide. This figure is not abstract modeling. It is the concrete downstream impact of the regulatory decisions currently being negotiated through the OC's proposed rules, the FDIC's April 7th guidance, Brookings Institution, and ABA comment letters, and behind-the-scenes negotiations among the White House, the crypto industry, and the banking sector, still ongoing as of late March 2026. A small business owner in Ohio, seeking financing for new equipment on a community bank line, cannot know that a regulatory loophole in the Genius Act could affect their bank's deposit base, potentially diverting funds to higher-yield stablecoin platforms. They are unaware that the Federal Reserve has modeled a potential reduction of $65 billion industry-wide if the regulatory outcome goes unfavorably. This analysis consolidates that regulatory and financial intelligence, translating Federal Reserve papers, ABA warnings, and public comment letters into clear language any American with community bank relationships needs. Depositors must understand that the regulatory window closes on July 18th. The loophole is open now. Deposit migration is underway, initially slow, but accelerating as early adopters demonstrate yield advantages. The regulations that determine the pace and scale of migration are being drafted during comment periods closing in the coming weeks. These next 10 weeks will decide whether the Genius Trap closes safely or springs wide.